So, yeah, hello everyone. So, thanks for joining in this very important LinkedIn Live. This is very important because we are talking about two very important concepts in global taxation. And in the world which we live in today, uh, your globalization is very much important, right? In our fast moving world wherein businesses are evolving through globalization. And today, for the real growth for India to travel the journey of 10 trillion economy, we need to go global. We need to start exporting a lot of services, start exporting a lot of goods. So there is a need for our business owners to create entities, their business headquarters or business branch offices outside India, right? And thus this LinkedIn Live becomes very important, because in this LinkedIn Live we will talk about the important aspects of setting your structure in the right manner. And very important takeaway would be in terms of how do you plan better in terms of what you should do, right? In terms of where how do you set up, and the structure and all those things. So let me start with something which came to my mind very recently. And there was a study which suggested that the new businesses which are getting incorporated in US, in Dubai and Singapore are being incorporated by founders and are being incorporated by Indian founders. So more than 50% of new businesses mostly, and majority of those new companies are being created from business owners who are actually not residing in US, Dubai or Singapore. So that means there are many business owners who are in India, but they're still creating companies in Dubai, Singapore and US. Why I'm saying Dubai, Singapore and US? Because Dubai, Singapore and US uh, consolidated takes around 70% of the new companies which are being created outside by Indian founders, right? And we also know that in the recent past there are notices left, right, center flying from income tax department, from corporate law, from Ministry of Corporate Affairs, from RBI, in terms of how these companies are being incorporated, and they are asking serious questions in terms of how the companies are being structured, right? And there are two concepts which are very important in this regard. And this video will actually cover in detail the two concepts. One is your General Anti-Avoidance Rules, which is also called GAAR, which basically talks about that when you incorporate a company outside India, you should not incorporate a company outside India just to avoid taxes by getting into some arrangement or agreements which the government might feel that you have just done that to evade taxes, right? And the second concept is in terms of place of effective control and management, wherein if the commercial or the larger decisions are being taken from India, even though the company is situated outside India, the government might say that this company is actually, the effective control and management is from India, so that the government can tax that company under income tax in India. So these are the two very important concepts which we will discuss today. And with this, I have got my team member Yogesh with me, who will help us to discuss these concepts in detail. So Yogesh, I welcome you to this LinkedIn webinar, and let's start. So you can go to the next slide, and we can start doing this.
Thank you, sir. Hello, friends. We are today here with the
You can be
concept of
little louder. You can be little louder. Yeah.
okay, sir.
Yeah.
Today we are here with the concept of the GAR and the poem. Both of these concepts are different and but have a common perspective with taxing the taxpayers for any kind of arrangements that leads to the tax avoidance. So let me give you an overall brief for the two concepts, how they differ, and what are the de minimis or the grandfathering effect they have. So let's start with the poem, which is the place of effective management. It basically deals with the residential status of the entity and distinguishes the entity between the entity's country of jurisdiction and The modus operandi of it is different from GAAR in perspective to the place of effective management of an entity, which is determined on the basis of the active business outside India. And there are some other guidelines also which has to be kept in mind while implementing POEM. With regard to the threshold or the de minimis, it targets companies with an annual turnover of rupees 50 crores or more. So there's a de minimis also set. When we come to the timing of evaluation, every year under the POEM, a company would be evaluated. It is not transaction based, it is not a particular time based, but overall throughout the year, the company would be evaluated to determine whether the residentialship of the company is Indian or not. When we come to the operation, then there are predefined guidelines which the POEM has to follow to determine a company for the purpose of residentialship. So now let me come to the GAAR perspective. How GAAR is different from POEM. GAAR is more transaction or an arrangement focused. It basically it targets those transactions or arrangements that leads to tax benefit, and there are tax avoidance. So when these situations come into the picture, the GAAR is implemented. And the heart and soul of the GAAR is identifying the impermissible avoidance arrangement, which leads to the tax avoidance. And yes, there is a de minimis also under the GAAR. It targets the entity where the tax benefit to all parties exceeds rupees 3 crores. So a de minimis is set under the GAAR also, under the POEM also. When we come to the timing of evaluation, there is no particular time. There is no particular like a year on year basis. It would the company would be evaluated. No, it is more transaction or the arrangement based. So a company, it is so if any transaction or any arrangement which leads to the tax avoidance, it will come into the ambit of the GAAR. And then it empowers the income tax authorities to give overriding effect on the existing provisions of the income tax law to identify transactions which lacks commercial substance or are primarily done to tax advantage, as I told before. So this is an overall look or the difference between the POEM and the GAAR, the two concepts.
So, Yogesh, if I want to summarize, if you can go back to the earlier slide. So basically, these two concepts are very important because these concepts actually determines whether the entity which is situated outside India is being created for what purpose, and through what lenses the government sees these entities which are created outside India. Now, POEM is more based on the control and management in terms of day-to-day control and management, and it's basically fine even though the tax residency may be outside India, but it's talk about in terms of how are you controlling those entities, how you're doing larger decision making on a daily basis. GAAR, you rightly said, GAAR is more based on transactional point of view, wherein there may be, so you have created an entity wherein and the entity is being created to get into an arrangement or an agreement with third parties which leads to tax avoidance. So there may be scenario wherein and we will get into those scenarios, and the threshold for GAAR is 3 CR and threshold for POEM is 50 CR annually. So I think so two fundamental difference. POEM talks about larger uh, determining the tax residency or tax jurisdiction in terms of which jurisdiction has the right to tax that entity, and then once that is established, then the government can actually go and tax everything, all the profits, if that it is established that the POEM or the place of effective control and management actually sits in India. GAAR talks about on the transactional basis. So that's the main difference I wanted to stress upon.
Absolutely. Absolutely.
Yeah, we can move ahead.
So before let's dive into the concept of the GAAR. Let's take a deep dive into it. So before we understand how does the GAAR operates, it is very important for us to understand the terms or the transactions that leads to the GAAR operation. So let's familiarize ourselves with the technical terms like tax evasion or tax avoidance or tax mitigation. How do these three terms differ amongst each other, and where does the GAAR comes in? So when we talk about the tax evasion, It's the willful suppression of facts or the misrepresentations and fraud. The tax advantage is taken by not complying the law, and this action is a negative kind of action which is prohibited by law, and it comes into the domain of the existing jurisprudence. And yes, certainly there is a loss to the revenue authority. So when we are into the tax evasion situation, then these are the parameters. Now coming next to the tax avoidance, it is an action taken by the taxpayer, none of which are illegal or forbidden by the law. The tax taken, the tax advantage taken is by complying the law, but still it is a negative action. It is illegal by law, and here comes the GAAR into the picture because there is a loss to the revenue authority. Now, when we come to the next term, which is the tax mitigation, it is more positive term. It is more legal, and it doesn't lead to the loss to the revenue authority, because here a taxpayer takes advantage of fiscal incentives provided to them by tax legislation by complying its conditions. So these are the three terms which we need to familiarize ourselves before we get into the GAAR picture.
Right, right. Got it. Got it. We can move ahead.
So let's take a example of the Vodafone case. This example is a very prudent example to illustrate the arrangement or the transaction that leads to the tax avoidance scheme, and the GAAR comes into the picture. So as we can see over here in this slide, that there is a company called Hutchison International, which was incorporated in a tax haven in the Hong Kong, and there was another company which was incorporated in the Cayman Island, which was the CGP Investment. So the CGP was a 100% subsidiary of the Hutchison International, and the ISAR Group, which is the third company, was operating in India. So Hutchison International wanted to acquire the shares of the ISAR Group of the India. So what it did is it transferred somewhere around rupees 10,000 crores to the CGP Investment Company, and the CGP Investment Company acquired the shares of the ISAR Groups around 66.67%. So what happened ultimately? The Hutchison International is the parent company for the CGP investment and is the parent company for the ISAR Group. So let's move to the next slide. Here what happens, that another company which was there in the Netherlands, which was the Vodafone International, it had the interest to buy the ISAR Group company, which has now become the subsidiary of the Hutchison International. So what happened, that the Vodafone International and the Hutchison, both of them went to the Australia, made the arrangement there, and the deal was finalized outside India. Vodafone International transferred rupees 60,000 crores to the Hutchison International and acquired the 100% shares of the CGP International, not of the ISAR Group, but of the CGP International. So ultimately what happened, that the Vodafone International got the holding of the ISAR Group by acquiring the shares of the CGP International. So what happened over here, that since no transaction was incurred in India, nor the shares of the Indian entity was transferred, and the transaction was incurred between the two non-residents, which was the Vodafone International and the Hutchison International. The SSE, the Vodafone, was of contention that there arises no tax liability in India.
Right.
But here in India, the AO was of contention that the value of the shares of the CGP has been driven by the business which was operating in India, which is the ISAR Group. So as per his consensus, it was a tax avoidance situation altogether.
Right. Yogesh, so this is very important, and this was very popular case because this raised
Absolutely.
eyebrows. This raised eyebrows. It went to Supreme Court, and there was a retrospective amendment which was made in the laws. And post that, the GAAR and the poem, everything came about, right? So this was very, very interesting case wherein by transferring 100% shares of CGP investment by H International to Vodafone, the control of the Indian Hutch group was completely transferred. So they thought that since that no transaction is happening in India, the assets of the Indian entity are not being transferred. There is no capital gain in India. But I think the government realized that this method may be used in future wherein indirectly the assets of the Indian company will get transferred without the Indian government having any say or any tax on that. And this was a game changing case in our life, at least in my life in last 10 years. So just go to the next slide, because next slide will be very, very interesting, wherein the Bombay High Court actually ruled in favor of AO, because uh, AO had passed an order of 10,000 crore against Vodafone, which was challenged by Vodafone in Supreme Court. Interestingly, Supreme Court, being the ultimate decision maker on our land, ruled against the AO and in favor of Vodafone, because they took it from a practical perspective, and they decided on the law which was there on ground at that point of time, rather than going into substance in terms of why this has been done, right? And
Absolutely.
they said there is no tax liability because nothing has transferred within India. And then this happened in Finance Act 2012. uh, to overcome the ruling of Supreme Court, the government amended the law retrospectively, nullified the judgment of Supreme Court, uh, and then technically what happened, that the judgment of Bombay High Court upheld because of the amendment in the law. And to move ahead, to overcome such tax avoidance in future, GAAR was adopted. So that's the background story of why GAAR came in, because the government in a way thought that this transaction which had happened, or which was created as an arrangement in Hutch and Vodafone case, was a clear case way of creating a arrangement or a transaction to avoid tax to be paid in India, right? So I think that this was a very interesting case. Yeah, we can move ahead. Yeah.
Yes, sir. So GAAR, let's talk more about the GAAR that it came into effect from April 1, 2017. So all the arrangements which were made prior to April 2017, GAAR doesn't have control over them. They are outside the ambit of the GAAR, and GAAR empowers and guards the revenue authorities against the schemes that are designed for tax avoidance. The revenue authority can now deny tax benefit for transactions they consider impermissible and doesn't have commercial substance or are primarily done to obtain the tax advantage position.
Right.
So, what are the exemptions under the GAAR? So exemptions are basically given to the FIIs subject to few conditions that they satisfy, which includes that FII should be the SSE under the Act. They have not taken any benefit under the DTAA and has invested in listed or unlisted securities with prior permission. So these exception or the conditions are exclusively for the FIIs. So, and yes, there is a de minimis level also set, which is the aggregate tax benefit in the related AY to all parties does not exceed rupees 3 crores, and the grandfathering effect, which is any arrangements that was made prior to April 1, 2017 remains outside the ambit of the GAAR.
So basically, there are three conditions wherein GAAR will not apply, right? One
Right.
is if the FIIs are the SSC under the Income Tax Act, so they become the SSC by taking the PAN number and do the activities in India. Second is they have not taken the benefit of DTAA under India tax treaty and with any other country, and they have invested into Indian companies, either listed, unlisted, with prior permission, right? The 3 crore limit is there, and any arrangement or agreement which is prior to 1st April 2017 doesn't come under this. So these are the three broad areas wherein GAAR will not apply.
Right.
But I think let's move quickly to a point wherein what are the arrangements, or what are the areas wherein in terms of how government treats arrangement as arrangement which is created to mitigate or evade taxes. If you can move to that.
Yes, sir. So, as I said before or mentioned before, that the heart and soul to implement the GAAR is to identify any transactions which satisfies the impermissible avoidance arrangement, which we will discuss in the next slide. So, GAAR is applicable on arrangements. In order to plug any loophole, GAAR provisions will apply to any step or a part of an arrangement as they are applicable to whole arrangement. It comes with the overriding effect, which I mentioned before, and no corresponding adjustment will be made or given to the other party who is a participant in that arrangement. So suppose if a particular company comes under the ambit of the GAAR and adjustments or the tax liabilities are imposed on a particular company, so that will not have the effect to the other company. So
Got it. Got it. Let's move ahead.
so what is impermissible avoidance arrangement? Let's understand that. For an arrangement or transaction to qualify as an impermissible avoidance arrangement, it has to satisfy dual conditions. Condition number one is that the main purpose is to obtain the tax benefit. This is satisfied. Then the condition number two is a tainted element test, which consists of four tests. If either of the tests is satisfied, then that transaction or the arrangement will be called as impermissible avoidance arrangement, and it will come into the GAAR ambit. And those four tests are mentioned, like creates rights or obligations which are not ordinarily created between persons or dealing at arm's length, or directly or indirectly results in the misuse or abuse of the provision of the act, lacks commercial substance, or is deemed to be deficient in commercial substance in whole or in part. Test 4 says that is entered into or carried out by means or in a manner which are not ordinarily employed for a bona fide purpose. If
So
I have to
basically, yeah.
if I have to give an example of this test, then one of the tests could be like, suppose if India has a DTA with another country, and that DTA specifically mentions that the other country, if it holds 10% of the equity shares in the India, then the taxability will arise in India. While if it holds less than 10%, then the taxability would arise in the other country. So what happens that the SSE in the other country incorporates two subsidiary companies and invest in the Indian company for that, and that investment is less than 10%, say 9% around. So what happens that there is a tax benefit taken, and the arrangement is also done for the, it's an abuse for the provision of the act. So those kind of arrangements or transactions are regarded as IAA under the GAAR.
Right, Yogesh. So basically, as you rightly said, the heart and soul of GAAR is identifying impermissible avoidance agreements or arrangements, as we say. And there are two conditions which you have pointed out. One is the primary condition, and the second is the test element condition. The primary condition is that the main purpose of that arrangement is to obtain tax benefit, right? सो आप सबसे जो पहला प्राइमरी ऑब्जेक्टिव है कि हमको टैक्स बचाना है, टैक्स बेनिफिट करने के लिए हमने वो अरेंजमेंट में वी गॉट इनटू दैट अरेंजमेंट. देन देयर आर element test which are there are four tests which I'm just trying to summarize. One is wherein you create rights or obligation which are not there normally at arm's length situation.
Correct.
Then there are directly or indirectly results, and that directly or indirectly results into misuse or abuse of provisions of the act. So you create some rights via agreements or arrangement which you will not do in normally in an arm's length situation, which is causing or abusing, misusing the provisions of the act, which also lacks commercial substance or is deemed to be deficient in commercial substance, and is entered into or carried out by means or in a manner which are not ordinarily employed. अगर ये conditions हैं इसमें से कुछ, तो then we can say that is the government might say that this is an arrangement which is impermissible avoidance agreement, and they will revoke GAAR, right? So how do we how GAAR is revoked? If we get to know that also now.
So, sir, GAAR is invoked in, there are three channels. First is the tax officer, the next is the CIT, and the third is the this approving panel. So what happens that if the assessing officer or the tax officer finds an arrangement which qualifies as IAA, then he takes the approval of the principal commissioner, and both of them examines the transaction whether it qualifies as IAA or not. So Next is like when in the opinion of CIT, the Commissioner of Income Tax, the transaction is IAA, then an opportunity of being heard is given to the SSE to prove himself that such transaction is not IAA, which is the impermissible avoidance arrangement. So if at that point the SSE proves himself or the transaction is not IAA, then the case can be dismissed then and there only. It doesn't move to the next higher authority. But in case if he fails to prove himself, then that case is moved to the next higher authority, which is the approving panel. And once again, the opportunity of being heard is given to the SSE by the approving panel to prove that the arrangement is not IAA. So basically, two opportunities are given to the SSE, and the authorities right now are the three, which are the assessing officer, the CIT, and the approving panel. And the direction of the approving panel is binding on the CIT and the taxpayer. So no appeal against this order is permitted.
Right. So this is the methodology in terms of how GAAR is invoked in a particular case, and it starts from the assessing officer at the ground level to the point of principal commissioner, and then it goes to the approving panel. So there are layers within which the GAAR is evoked, and GAAR is and there are enough opportunity which is given to the SSE, wherein the income tax department feels that the arrangement, a particular arrangement is being done to evade taxes. So there is a process completely which has been set out, and as of now, GAAR has been evoked in very less number of cases, which are in the upwards of 500 to 400 crores of evasion at this point of time. So the government is very selective in terms of where they are invoking GAAR at this point of time.
Absolutely.
But it's very important that when we go and incorporate our company outside India or get into arrangement with entities, we take into consideration that the right way of arranging that transaction, so that it should not be termed as something which is just done to evade taxes. There has to be a business substance to do that, right?
Absolutely. So next, when the decision of the approving panel is passed, for the redressal of that decision, the SSE again has the two layers or the two opportunities which he can use, which is the remedy, which is under the act. He can go and appeal to the ITAT, and if he is not if it's aggrieved by the order of the ITAT, then he can proceed to the high courts and take the constitutional remedy that he is aggrieved with the orders of the approving panel on the ground of violation of the principles of natural justice, or there is any misapplication of the law. So two remedies aspects are there before the SSE.
Right. So let's move ahead. Yeah.
So this completes our GAAR portion, and let's start with the place of effective management now. So the background for the place of effective management, let's understand first the background. The Indian companies over here, which are incorporated, are taxed at 25% rate. And suppose companies incorporated outside India, then they are taxed at, as per the foreign companies law. So here I have taken the example of the Singapore. In the Singapore, generally the corporate tax rate is 17%. So what happens that the Indian companies or the businesses started incorporating companies outside India and took the benefit of the lower tax rate, though all the key decisions were taken from India. So what happened that the government introduced the residential clause, which is the section 6(3), and to bring those companies into the ambit of the tax by declaring them as a residential. So once the foreign company's residential status based on POEM is established to be resident instead of non-resident, such company will be taxed at 40% rate, and its global income will be taxable in India. Let's understand this scenario with a flow chart. What happens that The residentialship of a company, if it's incorporated in India, then it's called Indian company. And if it's incorporated outside India, then we have to check the POEM, the place of effective management. If the place of effective management is in India in that year, if it's proven, then that company would be regarded as Indian company and would come into the ambit of, residentialship of India, and the tax rate would be then 40%, and all the global income of that company would be taxable. If it doesn't satisfy the POEM, place no, if it doesn't satisfy, then that company would be regarded as a foreign company. So place of effective management, if it's proven that it's outside India, then it will be regarded as a foreign company. If it's proven otherwise, that the place of effective management was in India, though it's a foreign company incorporated outside India, it would be regarded as Indian company and would be brought into the tax ambit of the Indian authorities, the Indian Income Tax Act.
So there is one thing which is very, very important, friends, in this scenario, and difference between GAAR and POEM. So GAAR talks about a particular tax, a particular agreement, arrangement, situation. POEM talks about your residency for the complete year. So if it's proved that for a particular financial year, the company is actually under POEM and its effective control and management sits in India, then for that particular year, the complete income and the complete thing can be taxed in India. So that's the main difference between GAAR and POEM.
So next is what is POEM? Having understood the background, POEM stands for Place of Effective Management, and it contains certain rules to be examined to establish the residentialship of the company. And POEM requires to be determined each year. It's not like if in a particular year, if the POEM is established outside India, so that company would be regarded as foreign company. Every year for the company, this test has to be carried out. Then it may happen that an entity has more than one POEM, but only one POEM can be considered at a given point of time. This concept is well recognized and accepted by various countries, including OECD, and its applicability came in effect from 1st April 2017.
Yeah, we can move ahead. So
the
both POEM and GAAR came from 1st April 2017. Interestingly.
Yes, this is the similarity between the most.
And there is a reason for that.
Okay.
Yeah.
The place of decision making overrules the place of decision implementation under the POEM concept. So if decisions are taken in a particular country, and the decisions are implemented in another country, then the place where the decisions are taken are given more weightage against the place where the decisions are implemented under the POEM. And it's not applicability is that the de minimis it has said, it is not applicable on companies with a turnover of rupees 50 crores or less in a financial year. So that's the de minimis it has said.
Right, right. So basically under POEM, the limit is 50 CR for the group. That is very, very important. It is not for that particular entity. So if you have a holding company in India and your subsidiary sits in Singapore, and the overall group turnover is less than 50 CR, then you are out of the GAAR POEM. If it's more than 50 CR, then you are under POEM, and then you have to prove that your effective control and management of the entity sits outside India and not in India.
Absolutely.
And there are various tests which we will discuss now in terms of when POEM is evoked.
Right. So again, like in GAAR, there was a heart and soul of the IAA there. So the active business outside India is the heart and soul of the POEM. That condition has to be satisfied. If that is satisfied, the entity would be regarded as place of effective management is outside India and would be regarded as foreign company. Yes, there are some guidelines for identifying key persons, locations who make the commercial decisions. There are guidelines for identifying the place where these decisions are taken, and there are guidelines for identifying the location or activity or the accounting records where they are kept. So on these basis also poem is determined.
Yes. So
So
one thing which is very, very important in this, which Yogesh has suggested, is active business outside India. And in the next slide, we will discuss in terms of what is called active business outside India. Yeah, let's move ahead.
so for an entity or active business outside India, there are some 5 tests that has to be conducted to prove that the company is a foreign company. And those tests are like passive income test, the asset test, the number of employee test, the payroll test, and the board meeting test. What happens in the passive income test, we will familiarize ourselves with the passive income term also in the next slide. But over here is like if passive income is less than 50% of its total income, then active business is outside India, the poem is outside India, it satisfies. So the company is free. Next is the asset test, which under which it has to be proven that the less than 50% of its total asset is situated in India. Under the number of employees test, less than 50% of its total number of employees are situated in India. And based on this only, there is a payroll test which says that the expenses on employees in India is less than 50% of total payroll test. And then we will check the majority of the board meetings are taken outside India. So these are some of the parameters which are given in the active business outside India test that has to be satisfied for a company to be called as a company located outside India or a foreign company.
Right.
So,
So these
and
are
yes,
very
one more important thing which I want to highlight, that all this data has to be done the averaging, and averaging has to be done for a maximum of 3 years. But there may be instances where the company has been incorporated for less than 3 years. In that case, that minimum, from the since the company has incorporated to the time which this ABOI test is being conducted, that period can be taken.
right.
So
And this
average
and
of
this data is for the group.
this data is for a particular company, sir.
Yeah, right.
So let's move to the next slide. See what's the passive income means. So basically the passive income is the aggregate of the income from transaction between associated enterprise plus some specific incomes. So what can be the transactions between the associated enterprise? It can be the purchase or the sale, the income driven by the purchase or the sale. That aggregate income has to be taken into consideration. Then there are some specific incomes such as royalty or the dividends or the capital gains or the interest or the rental incomes. So interest portion can be excluded if the company is engaged in the business of banking or financial institutions. So passive income has to be less than the total, it has to be less than 50% of the total income. This is one of the passive income test.
Right, right, right. We can move ahead.
So income to be computed as per the tax laws, these all, and if in a particular, country, if there isn't any tax law, then this income can be as per the books of account.
Right.
So next is the asset test. Once again, the asset has been categorized into 3, different categories: depreciable asset and individual depreciable asset, the block of depreciable assets, and the other assets. For the other assets, value as per books of accounts can be taken. For the individual depreciable assets, average of beginning and closing value of assets computed for tax purpose has to be taken into account. For the block of depreciable assets, average of beginning and closing value of block of assets computed for tax purpose has to be taken. Now, when this total is done, it should be the assets should be less than 50% located in India, the total of these assets. The next is the total number of employees, which says that the capacity of a company, if says is 100, then what is the capacity of those employees who are situated in India? That should be less than 50%. So this talks about the number of employees. Next, if we see the payroll expenses, so again, coming back to the last example, say 100 employees have been paid, say some 10 lakhs rupees. That what is the total amount of payment which is made to the employees which are situated in India? If that is less than 50%, then it's the poem is would be considered outside India.
Right. So these tests are very important. So first we have discussed about the passive income. Uh, then we have discussed about total assets. Then we talked about total number of employees and the payroll expenses. So if the total number of if the 50 is it's less than 50% which is there in India, then the poem sits outside India. I think this is very, very important. So when we structure, when we incorporate our entity, we have to be very mindful of these things.
Absolutely, sir.
Right. We can move ahead. So I think with this, our presentation ends. So let me just summarize in terms of poem and GAAR, or we can first take questions because we got some questions. So
So
yeah,
if it's a very simple question, and if the result of the active business outside India is established, where will be the poem considered? The answer is very simple, that the poem will be considered outside India.
right,
So the next question is, will the foreign company be said to be Indian resident in that case? No.
right. Only for the so if the poem is outside India, then the foreign company stays foreign company and it will be taxed in the country where it is situated, or for that matter, it depends if the place of active control in some other country. So it depends. So I will talk about very interesting story today at the end of this LinkedIn live. So we can move next.
Sure, sir. The next is the majority of the board meeting. It has to be proven that the majority of the board meetings are conducted outside India. Then the place of effective management would be considered in that country where those board meetings are held. However, there is an exception, or there is a pick in this, that if on the basis of facts and circumstances it is established that board of directors are just standing aside and are not exercising their power of management, and such powers are being exercised by either the holding company or by any other person, then poem will be considered to be in India instead of outside India. So these were the avoid test for
Right,
companies other than those engaged in the active business outside India. Following criteria are applicable. These are basically the guidelines. So again, it is based on the two stages. One has to identify the key person location who take the commercial decisions, and identifying the place where these decisions are taken. These are the two stages. And there are some guidelines with regard to the meetings to be held outside India. So what are the guidelines? That I'll just give a quick glance on that. So those guidelines are like a mere formal holding of board meeting at a place would by itself not conclusive for the determination of poem. The major factor in this includes whether key management and commercial decisions are taken or not in such place. That is the very key aspect. And if key decisions are taken outside that place, then such outside place will constitute as poem. If board has delegated their authority, there are certain circumstances where the board delegates their authority to the senior management to take the decisions or to make the decisions, and they just ratify those decisions. So in that case, the poem will be considered as the place where such decisions are made by the senior management. So sometimes the location of the company's head office also plays crucial role or crucial factor in determining the poem if key decisions are made there. And if key decisions are taken without physical presence, yes, this is very much common these days, that the senior most member of the company is sitting at some other place and he's using the technology, and the key decisions are taken. He participates in the meeting and the key decisions are taken. Then the place where he's using that technology, where he's situated, that place would be considered as a poem, place of effective management. So with this, we can say that we conclude the major portion of the poem. Next would be the how the assessments is done under the poem.
right. So there are a lot of tests, multiple layer tests under poem, and because of that, and it gives an average of 3 years, and there is an upper threshold of 50 CR. So because of that, it gives enough time for the business owners to structure their entities, because at the end of the day, business owners expand outside India for business reasons because they see that there are opportunities outside India, either to raise capital or to do larger business or to access the local market in that country. But it's very important that they uh, go and plan this in a way wherein the structure looks legitimate, and the structure actually gives you the long term business benefit, which is which for which you have created that structure. So I think this is very helpful. We can go to the next slide.
So next is if poem couldn't be determined on the basis of previous discussed guidelines, then it shall be determined on the basis of the activity, the substantial activity of the company, the place where the substantial activity of the company is carried out, or in certain cases where the accounting records of the companies are kept.
Right,
These are also one more guidelines you can say.
right, right, right.
Next is for the assessment procedure for the poem. So under poem, what happens that the assessing officer has to take the prior approval of the principal commissioner before initiating any proceedings for a company. If the AO, on the basis of his findings of the company incorporated outside India, is of the opinion that such company is resident in India, then before issuing any direction, an opportunity of being heard is given to the SSE. And once the poem is established to be in India, then such company will be given the residential status of India and shall be taxable as a foreign company at the rate of 40%, and its global income will be also taxable.
So thanks, Yogesh, for that. So with this, we end our LinkedIn Live, and thanks everyone for joining in. The objective of these LinkedIn Lives is very, very simple. We want to educate and we want to share the information and the knowledge which we have gathered over the last 23 years. And at the end of the day, as I started this LinkedIn Live with a single point that in the era of globalization, wherein Indian economy is growing very fast and wherein we are moving towards a 10 trillion economy, and everything is shining as far as India is concerned. There will be scenarios wherein the Indian business owners want to expand outside India because of the pricing leverage, because of the local market, because of the raising capital. And from our experience, which we have gathered in terms of helping close to 250 businesses in setting up outside India in different geographies, wherein we have our partners in different countries, we want to help and we want to handhold business owners who want to go global, but go global and achieve the objective and not unnecessarily get stuck into hassles of poem and GAAR, and then get distracted because of these things and not focus on the larger goal which they want to achieve, which is to grow their business, right? So this is what we want to do. And again, thanks for joining in. If you have any queries, we will be happy to answer. You can post as a comment to this LinkedIn Live, or you can drop an email to us, or you can get in touch with us. Thanks for joining in, and thanks Yogesh for helping us in creating this LinkedIn Live, and thanks everyone for joining in again. We will come back with more interesting topics, and do share this knowledge with your friend, with your colleague, with your business partner if they want this. And let's continue to grow the knowledge and educate ourselves as we grow and grow our business. Thank you again.
Thank you, sir.